All right. Let's move into something a little bit more serious.
Okay.
This is interesting. I think this is right up your alley, Randy. An interesting observation over the last almost 100 years, 99.3 years. The US stock market has averaged about 7% per year on a real basis after inflation.
Right.
Okay. And that's represented on this chart by the green line, the constant 7% growth line.
Okay.
And the stock market at times is traded above that, and then it trades below, and it always come back to that 7% line, above and below, and constantly climbed over a century. And now we're trending just a little bit above.
Right.
Okay. So, and here's a bit more detail in terms of the relative nature of this. So we had the roaring 20s where the stock market got way above that 7% compounded growth, came back in the Great Depression, overshot that, went down, recovered. We had World War II and then the post-World War II boom.
Wow.
The market was above that 7% line for quite a while, really a couple of decades. People were feeling pretty good. And then we had the higher inflation of the 70s, but knocked things back down again. And then we had the internet boom of the 1990s that took things back up again to inflated levels. That all came back down. And then in more recent years, we've had financial crisis. And then we've had a bump up there I labeled pandemic free money boost, which is this peak sort of right here. Okay. And then my question with this chart is now, are we going to enter into a new AI age where the economy is able to achieve faster growth and therefore the stock market can also achieve faster growth?
And I think you would want to do / new golden age via the Trump doctrine.
You could combine it with that if you wish.
Right.
The Trump situation may be a fleeting thing for the next 4 years, right? Hopefully
AI
in many ways, right? Whereas AI is not. AI is just going to be, it's a building trend actually that's probably going to be exponentially building in the next few years.
Right.
This for me is an interesting question because you would think that unlike some other tech developments, that AI continues to build on itself.
Right.
Right. Like the internet certainly had a bunch of sort of knock-on effects, but AI just continues to get better and better and better. Right. And so this will be interesting to see. Now, we've also identified some potential problems because along with AI, like robotaxi, for example, AI-driven automobiles, we're going to have a decline in the cost of transportation.
Right.
So in some ways, that's very harmful to economic growth because we're taking away money out of the system. But we should also then be able to reapply that in other areas. And historically, whenever we've done that, that's been a positive for the economy. Right?
Yes.
Even though some people are losing their jobs.
Yes.
The challenge with AI is we expect massive job loss over the longer term. So now we're into the situation where, okay, what kind of economic system are we going to have? And it's pretty clear it's going to look different than it does today.
Possibly. I still have my theories, that humans will find new ways to make a living, and that those new ways of making a living will have to do with the wealth effect for the rest of for the people that are now under 100,000 will live like the people over 100,000 live now. The people under 50,000 will live like the people under 100, So if I am somebody, let's say in my wealth class, I could easily afford massages if I wanted them. I have one of the best massage places in the country at the Mission Inn, just a few miles from my home. I could be down there every week. I could afford that. But if I'm making 60,000 a year, I can't afford to go there ever.
Yeah.
But it's the wealth transfer. All of a sudden, if I like massages, I can now do it. And now it may not be at the Mission Inn. It may be my own private robot that's giving me that massage.
Right. Yeah. Yeah, I mean, it's the thing that most of us were living a far better life than Napoleon did, for
Right.
example.
Much better.
Even though he was in fancy palaces, we
Right.
have better food and we live healthier lives, and
Right.
beds are more comfortable and all that stuff, right?
Exactly.
Better plumbing and all that stuff. So it's yeah, that we definitely expect that. But I thought this was an interesting relationship just over the last
I do
century.
too. I think this is one of the best charts you've ever done. I'm really proud of you.
Thank you.
No, I really like it. It's very cool.
Yeah. Okay. Let me share
By
with
the way,
you.
before you move away from it though,
Yeah.
if we look at the chart, the expectation, no, the other one, the expectation would be that this AI boom would at least do what the internet, the post-World War II, and the Roaring Twenties did. So we should at least go up to the 200% level that we were for a year or two or three as this thing really materializes, especially when you have Robotaxi, Optimus, and LLMs and agentic, et cetera, that's going to grow out of the LLMs. You would think we'd at least hit those levels. So then that would suggest that the S&P, at 24 times earnings or something would not be out over its skis.
Right. Yep. No, good observation. I think that's entirely possible as we start to see some of the effects of this. Yeah. Um, okay. Related to this is sometimes you see comments like this from investment folks. And not to pick on Peter Maluk. I think Peter does a great job. But this chart is very, very deceiving.
Hmm.
And let me share why. But first of all, I'll discuss what this chart is showing. So he's
Okay.
saying, want to build long-term wealth, be an owner, not a lender, right? Own stocks, not bonds. Stocks are
Okay.
far more likely to double your wealth in any given decade than bonds or cash.
Now we know
And he's
why the
showing.
bond market's in such trouble. It's because of Peter.
There you go. We've got your answer. So what Peter is showing here is that stocks, again, he's measuring it since 1928 to 24. So what's that, 96 years?
Right.
Um, that they double using the rule of 72, double about every seven years.
Right.
And bonds, based on their past results, double every 16 years.
Right.
And cash, 3-month T-bills,
Hmm.
double every 22 years.
Hmm.
Okay. Now, I saw this and I immediately thought of this. What this chart is not showing you is several things. For one, it's not showing you the returns after expenses, which is important.
Hmm.
It's not showing returns after taxes, which is also important.
Hmm.
Okay. It's not showing you the results, and more importantly, not showing you the results after inflation.
Yep. True. Hmm.
And the picture here is it's like the mouse taking a bite of your cheese every day.
Mm-hmm.
And at first, it's a nibble, and you don't really care and you don't notice. But if that mouse eats a bite of your cheese every single day, the amount of cheese that you have left is going to be a lot less, right? So you have to take into account the
Sure.
mouse eating your cheese.
Sure.
Okay. So here's what the chart really looks like.
Okay.
If you take into account inflation. So the blue bars are what Peter had in his chart,
Yep.
7.2, 16, and 22. If you take into account inflation using his data, stocks double about every 10 years,
Mm.
bonds every 40 years,
Wow.
and cash a mere 324 years. It would be a multi-generational family situation where, my great great grandfather left me this cash and it's now doubled. Okay. Again, assuming that past returns are
Yes.
indicative of the future and they're not.
Yes.
There's always that caveat.
Yes.
Okay. So that's the first message is you always have to consider returns after inflation. If you're not, you could be making a massive mistake thinking that bonds, will get you to the same place that stocks will, just on a smoother ride.
Right.
Maybe, maybe not.
Okay.
Okay? That's one of my messages.
Yep. Yep.
All right. While I'm on my high horse, let me stay on my high horse for a minute. Okay? The other thing is this is stocks, by the way. This is actually from 1926
Okay.
through the end of April.
Okay.
$1,000 is now worth almost $1 million in the stock market over these 99.3 years.
Okay.
We'll get to celebrate 100 years here soon, Randy. In December,
Yeah.
we can have a 100-year century party for the stock market. The problem is that these average returns that you see where stocks double every 10 years after inflation, you've got to take into account the variability. Because not everybody's time horizon is 100 years. Okay? If you invested back here and you were still around, that's great. But if you invested here and your time horizon was 5 years, then this wasn't so good.
Right.
Right. And there's been plenty of periods where stocks were down for a good long period of time. And just to make that point home, drill that point home, here are stock returns over 1-year periods. It's about a 50-50 split between positive or negative in any given 1-year period.
Right.
Okay. Slightly favoring the positives, maybe 54% positive, something like that. Here it is over 5-year time periods. Again, slightly more positive than negative 5-year periods.
Right.
Okay. 10-year periods. You think that investing for the long term is 10 years? There are still some 10-year periods in our history where stock returns were negative.
Right.
20-year periods?
In
the United States, none. All were positive.
Huh.
But plenty of them, you had returns lower than that 7% long-term average.
Oh, yeah, a lot lower, like 2%,
right?
1%. Yeah.
Yeah. Right. Now, again, positive return after inflation, but not much.
Yeah. Yeah.
So just be careful when you're looking at historical numbers. Now, here's the same thing for bonds. Since 1926, $1,000 in bonds would be worth $6,400 in real terms. Okay, again, it was almost $1 million for stocks.
Right. 6,000.
And it's only 6,000 plus for bonds. Okay. And look at this period here, where if you were here and invested, this was a long period of time where you lost a lot of money in bonds.
Yeah. Yeah.
And you know what? We might be seeing kind of a period like that here. Who knows?
Yeah.
Same charts for bonds. Here are the 1-year returns. We've just been through the worst bond market ever.
Right.
For 1 year. 5 years, we're among the worst. We've been through bad 5-year periods before. 10 years, pretty bad. 20 years, there have been 20-year periods where you lost money in bonds.
Yeah.
There's also been 20-year periods where bonds were incredible.
Yes.
Okay. So, all right. And then just to round it out, here's cash. Here's 3-month T-bills. $1,000 in T-bills. 1,368 today. Those people that are going to double their money eventually, right? Here are the 1-year periods, again, very similar to bonds, up and down. 5-year periods, plenty of negative returns. 10-year periods of cash, you lose money over 10 years in cash all the time. And then 20-year periods, that can happen too.
Yeah.
And again, look, recent times since, let's say, 2017 maybe, all the 20-year periods since then, like up to then and then since then, have been negative for cash. Okay. So I'll get off my soapbox now, but I just wanted to give people perspective about just be careful when you look at long-term stock market averages. It's really highly dependent upon your starting point and the environment that we find ourselves in. So you always have to look at current conditions and say, is it even possible to get anywhere near the historical return on these investments? So is it possible to get higher than historical returns based on where we're starting?
Yeah. If you happen to be a big fan of the Cybertruck, you might also be interested in this super fun Cybertruck refrigerator magnet and bottle opener. It is made out of super thick stainless steel, just like the Cybertruck, and it has this giant magnet on the back, so it's going to hold a lot of stuff on your refrigerator. It's an amazing gift, and it comes in that great gift box that you saw before that uses a magnet opener, just almost like an Apple box, like when you get Apple products. You can buy it on Amazon for $29.95, or you can buy it direct from me by sending $25 to paypal.me/Randy Kirk, all in lowercase letters. Please indicate whether you want the stainless steel look, or maybe you'd like to have this very clever camo version. And then if you're not in the US, please add $20 for freight. If you'd like more than one, please check the information below to get pricing, as well as all that information I just told you will be repeated in the information below. So once again, think about joining the channel, getting the up-to-date Tesla news every single day. I think you'll be glad you did.